welcome to the third episode of the Validus View. Last time we looked back at kind of 15 years of growth at Validus, and two of the themes that we hit upon were kind of our expansion into new products and markets and kind of the increased digitization of our business. And I think the topic we're going to talk about today hits on sort of both of those themes. We're going to talk about a product called our Fund Finance Ops product, which we launched earlier this year. I'm joined by Conor, who's the product lead on Fund Finance Ops, and Laila, who works in our Fund Finance Advisory business. So maybe to kick things off, if I can ask you guys to briefly introduce yourselves, maybe start with Laila.
I joined Validus about a year and a half ago. Prior to, I was at a bank for about 5 years in their financial institutions group. I'm based out of our London office here at Validus, and I'm on the Fund Finance Advisory team.
Perfect, thanks. Conor?
Been at Validus about 4 years. Originally joined through our ISD advisory team, put in a bit of work there, designing product to manage operations on the ISDA side, and have recently started porting that across to the fund finance side of the business.
Excellent. So today we're going to be talking about fund finance, which is, I think, an incredibly interesting part of the private capital landscape. It's obviously grown a lot over the last 3 or 4 years, both in terms of the size of the market, but also in terms of the products on offer and the complexity. So maybe I'll start with Laila. Working in our fund finance advisory business, you come into contact with a lot of users of fund finance products in terms of private capital managers. You also talk to a lot of providers, and maybe just to be good to get a sense of the landscape and the state of play in fund finance today.
Yeah, sure. So just to give a bit of background of what we do, so we help managers raise in their fund finance facilities, so whether that be capital call lines, NAV facilities, GP facilities, Banco facilities. It kind of runs the gamut of what we do. From what I've seen and from what I've heard, what used to be nice to have that managers would look to have, whether it be like a capital call line, not so much NAV facilities in the beginning of the market, is now kind of a must-have. About 80% of managers leverage fund finance facilities in some capacity. And so you're seeing a lot of evolution, I think, now with liquidity being, it is a ubiquitous market. Managers are able to get liquidity in different avenues, but there is that still sentiment of uncertainty, just considering where we are geopolitically, this from different pockets of the market. And so managers are finding different ways of guaranteeing their liquidity. So you're seeing a lot of creativity, whether it become the actual structure of the facility, where they may be looking to tranche, or they may be looking to term a certain part of their capital call line, or they may be looking to diversify their panel of banks that they work with. I think any ways of guaranteeing that, in a couple of years' time, that it won't be an issue to ensure that they're able to leverage their fund finance facilities. The market is definitely steering that direction, where it's more creative and more bespoke to specific managers' needs.
Yeah. When you say it's turning from a kind of a nice to have into a need to have, what are the kind of the underlying factors behind that transition?
Yeah, I think, in theory, you can run a fund without any form of financing. I mean, you just call capital from your investors, you're able to make your investments. You don't necessarily need the capital call line facility in order to have a functioning, fund. But I think if you look to see of ways of stretching that liquidity and ensuring that you're able to money in the ground faster, you're able to make investments that you probably wouldn't be able to make because you have a readily available source of liquidity, it then becomes a must to have. If you look at your NAV facilities, right now the fundraising market, it may be slightly improving, but it's still in a place where managers are not able to tap into liquidity sources that they may have been within, let's say, call it 3, 4, or 5 years ago. You're looking at NAV facilities, we're able to expand that liquidity longer by leveraging your actual assets as your collateral. So in a market where you're not able to get that fundraising as fast as you were before, you kind of need to find different ways to be creative in order to continue to keep your business running as long as it needs to, if you're not able to tap into the M&A market or the IPO market as readily as you were before.
And to flip it around and look at it from the other perspective, so from the providers of fund finance, how have you seen that change over the last few years in terms of who they are, their appetite, their behaviors?
Yeah, definitely. So I think 2023 is a year that we the fund finance market doesn't forget, where you saw a lot of, capital calling providers exiting the market for various reasons. And I think that kind of spooked a lot of borrowers in terms of where the relationships lie. And now you're seeing a lot of those, providers come back into the market in different capacities. You're seeing a lot of private credit lenders. I mean, I think within the past 10 years, it's something that's been discussed, but you're seeing, even more than before, a lot more lenders in the market. It seems like there's a lot more supply. And with that causes, pricing tightening. So you're seeing pricing come in a lot tighter. You're seeing advance rates, become more favorable to the borrower. You're seeing LTV ratio. So the structures of the facilities are changing as new entrants are coming in. And so we had a conversation with a prospective client a week or so ago where they were saying that banks that are completely out of their, jurisdiction or, never considered that they would be calling them up are now saying, hey, we'd be interested in providing a capital call line. So a product where a bank used to be hesitant to kind of lend just because if you look at RWA, it may not be the most attractive product where lenders might want to put their capital. Now you're seeing lenders who are going out of their way to reach out to borrowers to see where they can create relationships within the fund finance market.
Great. So yeah, I think we're seeing a market that's obviously evolving quickly, changing quickly. We've been in this market in an advisory capacity for 7 or 8 years now as a firm. But recently we've kind of moved to a slightly different area and developing purpose-built technology to help managers manage their fund finance operations. I think it's a pretty interesting story how that came about. So maybe I'll pass it over to Conor to talk a little bit about the product, the story behind the development of that product, and kind of what it does for clients. How does it make their lives easier?
Yeah, absolutely. So I think in terms of the product, essentially software as a service model. So we have front office people who do this day in, day out, specialists in what they do, and we have built a technology platform which allows them to service these facilities at scale, but also gives clients ownership of and oversight of the process, as well as ownership and access to the valuable data that comes out of that. And it's been a really successful model. We launched officially in September, have 5 clients on, and have a significant amount of interest in the market. In terms of how it came about, I think we're in a really valuable position. It's very strong client relationships across our advisory business. And it was very much a client that came to us and articulated that the way or the process they had in place to manage their facilities was becoming very challenging, difficult to scale as their business was growing, and whether we could step into it and help run that for them. Initially, the running it was, I suppose, relatively manual, but working with that client, we landed on the fact that we need a technology platform that gives shared access and shared ownership of the process. And fortunately, having a very strong platform already in place from our FX side of the business, and the interplay between FX and fund finance, it was just a logical step to have them live on the same place. I think we've also very fortunate to have both a fund finance advisory team as well as the operations team, because essentially, while it was client driven initially, we also have access to our advisory team. We're on the forefront of this and structuring products within an ever evolving market, so we get that foresight into where the market's going, what changes are coming down the pipe, and are able to build that flexibility into our product, so that when inevitably a client comes down the line and says, okay, we have this new structure, is your system able to handle it? We can say, well, yes, because our advisory team placed a similar structure maybe 6 months ago, and we had that foresight to add that into the platform.
So when you say a client came to us to kind of scope this out and partner with us effectively on it, how are they managing this process beforehand?
So prior to us being involved, it was very Excel driven. I think a story that's pretty consistent in the market. Most sponsors are currently running this over a multitude of Excel spreadsheets and preparing notices in Microsoft Word. This client was in fact also, very keen to keep the banks honest in terms of interest reconciliation. So we're reconciling every invoice that came across. If you think about a scenario in which you're receiving an aggregated invoice, not per draw, it can be quite challenging to reconcile that if you're working off of various isolated Excel spreadsheets and pulling in, fixing data and looking at what lookbacks you have to establish. It can be quite a disjointed process, and as with anything where you're dealing with a very large data set, things can go awry. Something booked a value date too soon, a value date too late, something attributed to one borrower instead of another. And unless it's a kind of single structured data set, it can be quite hard to sniff out those marginal errors. So far, the feedback's been fantastic. When a sponsor's scaling and it goes from maybe 2 or 3 facilities to managing 10, maybe they launch a few SMAs, which exponentially grow the number of facilities. To do it as a side of the desk responsibility can be quite challenging. So we're hearing from teams, very happy for us to step in and offer the support. The teams that are placing the facilities are very happy to know that the value that they can create through structuring into the facilities can actually be leveraged on the operational side. They're not limited to putting in place vanilla facilities just to ease the operational side, whereas maybe sponsors might focus on dealing with one lender to have a consistent process. With our tool implemented, they've been able to have a consistent process on their side, build the flexibility into the tool itself, so that now they can diversify their lending panel without facing a diversifying process or diversifying operations, which just allows that peace of mind on the placement side. And yeah, we've had some really positive feedback on all teams.
Great. I think you've alluded to it a little bit already, but in terms of like the ideal client profile for this product, is it a function of size? Is it a function of complexity? Like, how do you see that?
We've seen success across the spectrum, and I think that comes from the market is running very lean teams across the board, trying to do a lot with very little, and whether it be 10 facilities or 1 facility, if it's not the core focus, it can just be a distraction from what you're trying to do, and just handing it off to us has been quite, I think, rewarding for even teams on the smaller side.
And maybe turning to Laila, one of the big themes overall in private markets over the last few years has been around data and using data better. Is there kind of a data angle to this product in your view, in terms of clients being able to access better data or use data more effectively?
We have an example that we like to quote when we talk to clients of, there was a borrower where they had 2 capital call lines. One of them they didn't use. It was more of an end-of-life capital call facility. It was a 1-year facility. And another was a 2-year facility that they were actively using, but they wanted to renew both of them. They were looking to renew it, and the bank was not eager to do so, considering it was just a capital call line that was sitting on the balance sheet, which is, frankly, a lot of lenders' biggest fear is just having it sit there. And so we used the data from the Fund Finance Ops platform to see how much revenue that they'd been generating from the relationship. And that was a complete game changer. We put together a slide and maybe like a 10-page sim of other, up-to-date metrics about the fund. And that lender took it to their credit team, showed them the slide, and they were able to renew the facility. So data is power, and the more data you get and the more accurate it is, you may be able to leverage your relationships for the better.
And maybe now, if we just look forward, one of the themes we hear a lot about is increasing scrutiny from regulators, from investors. Does this product, in your view, play a role in kind of improving visibility for those parties?
Yeah, I would think so. I mean, I think now is a good time for borrowers to just know, what the relationships look like. Historically, it's been a bank market for fund finance. You still see, banks predominantly taking up a lot of the space in the market, but with private capital or private credit funds specifically coming in, you also see insurance companies coming in. I think, it's important to know exactly, how much capital is being allocated to each of them.
And how much you're paying for it, presumably, as well.
Yeah, definitely. We always say, it's a multifaceted experience, I guess, when you're looking to obtain a fund finance facility. It may be great that you have a really cheap line, but if you're not able to use it, whether it be the borrowing-based treatment is not favorable, or there's certain restrictions, or it may be for a certain amount of tenor. You may have a termed piece of the facility, and then it may go to a revolving piece. You may have a certain availability period. There are different structural components that may not make it advantageous for you. Having the data to know exactly how the facility will look, if you're able to forecast exactly how much of the cash flow will be used for each of the facilities, it gives you more powerful optionality when you're looking to source for different relationships.
Excellent. Yeah. So maybe just to end off then, Conor, looking forward with respect to this product, we talked a lot last time about kind of our approach at Validus of continuous improvement, always trying to, work with our clients, work with the market to improve our products and make sure that they're kind of cutting edge. If you look forward with respect to our fund finance ops product, do you have any sense of where this might go? Do you have a feeling of, what new enhancements, what new evolutions we might expect to see over the next 2 or 3 years?
Yeah, absolutely. I think one of the key themes is going to be integration across the platform. So a lot of value will be driven by having all of your facilities in one place. So whether that be, to Laila's point, your GP, Manco, subline, but also further down the structure, right? You're talking asset level debt, primarily around maybe real estate managers who don't have the fortune of being able to offload the management debt to the CFO, where the private equity side might. But equally on that private equity side, in terms of managing, particularly maybe their market risk in relation to those facilities, you might want to have access and have it live on the same platform so that what interest rate risk your company that you're invested in is running, how the CFO is managing that, and integrate it with the market hedging side of the business. How's the rate hedging in the same place? So I think pure integration across the business is going to be a big, I suppose, factor for us in the future. I think we already have it, particularly at the fund level, and our platform integrates quite well with the hedging side of our business. And if you think about how managers maybe have historically, call it US managers, had a focus on US side, and their facilities always had an implication to FX mark to market. However, it was always a zero sum to them. And there may be now to tightening on the US side, looking to other markets for their investments, and all of a sudden those FX components to their vanilla sublines actually mean something now, and they need to have that integrated. I think we tackle that very well today, and we're only going to get better at integrating up and down the structures as well.
Do you see a role for AI in all this?
I think so, to a degree. I think one of the things we offer is expertise in documentation. As part of our process, we're always giving a bit of a health check. I think inevitably when you're onboarding facilities into the platform, you catch one or two things that got into the subline doc, which maybe sponsors weren't intending, whether that be an end of life NAV covenant that doesn't actually have the holiday that was intended. So practically it can cause a technical breach where it wasn't the intention of the borrower or the lender. So having that, second set of eyes on a document is always valuable. And I think in terms of AI, it's going to allow that to be done quicker and at more of a scale. So I think it'll allow us leverage existing teams and existing teams' expertise to do more. I don't think it'll ever stand in fully. You're always going to want to have that front office touch. But yeah, I think it'll allow us to do a lot more and drive a lot more value for more clients.
AI could never replace you, Conor.
Great. Perfect. Well, listen, this has been a really interesting conversation. I think it's a very exciting part of private capital. I think it's a very exciting product, brand new, and very keen to see where it goes. So thanks very much, Conor. Thanks, Laila. Appreciate you joining me.